All right, so the up and down volatility continues with today's move. We're going to break down what we're looking for in terms of where we need to break out to the upside and considering what's going on in the after hours here, where support levels are to the downside to really have any significance to change this noise. And we're going to compare how volatile we've been here over the last few weeks, which considering we're only a few percentage points off the all-time highs, it seems that we're a lot more volatile. So I'm going to show you some charts that shows just how volatile we have been underneath the surface of a market that's only a few percentage points off of its all-time highs. What that means for us and what we can expect going forward, as well as our trade idea of the day with a high probability chart setup with a high probability strategy to take advantage of it. So let's go ahead and get started. Today is Wednesday, October the 9th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, if we take a look at the S&P 500 with the Market Forecast Indicator, you can see the intermediate line turned higher. It's still below 50, so we've got light green shading, not dark green. But you also notice the moving average is yellow, which means that we're below a rising moving average. The bearish pattern is dark pink shading and a red line, and obviously we don't have that here. So we're kind of there's been some volatility below the moving average, but we haven't been able to stay down. Every time we go down, we tend to bounce, and that's why your moving average is rising here. You also notice too, if I look at this near-term run and its Fibonacci retracement zone, which is this blue black line here, and you can see if I were to edit this and make that a dotted line, and then bring this one on too and make it a dotted line, your bigger retracement area, you can see that's where we pretty much stopped on the pullback. This bigger retracement zone, the more significant, the normal one between the 38 and 62% level, that's where we're at again here. And you also notice too where we stopped at the top end of that zone is also the top end of this large Fibonacci retracement zone of this intermediate rally. So 2950, there's going to be some resistance here. It's not, we're not going to really be able to take off until we break back up above that line. And you can also see too, there's a 23% retracement. We're really not going to be able to take off either until we get above these highs. So, that's kind of our levels to watch for. Until then, obviously we have a lot of support down here. So until we break through 2850 to the downside, 2800 becomes our next layer of volume support. You see that here on the Bollinger Band chart here, and let's pull up. Here we can look at it here on SPY. There's the area that we're at right now, and of course you break through here. Excuse me. There's a little bit of a gap. Now keep in mind this gap. There's as much volume in this gap that there is at that node here at 298, which is these highs right here. So there's a lot of volume down here, and it's going to be very easy for us to come down, but we're not going to fall off a cliff anytime soon. I tweeted that out here just a minute ago on this news that China might be leaving a day early without any significant progress. Stocks or the futures are down quite a bit. But we're still, it's not going to fall off a cliff. And you can see where the 2800, there's significant volume at 2800, similar to what we have here at 287, 288. So those are our levels to the downside, and of course our levels to the upside. So until we break 280 on the downside, or really 300 on the upside, everything's just noise. And you can see that in our trend strength indicator. There's day-to-day noise, there's ups and there's downs, and of course depending upon how you have your active trading account set up, your net lick will be going up and down. And here in the last couple of days we've gone up both days, on down days and up days. So that's why it's kind of nice to have a good balanced portfolio with what I teach you here in our active trading classes. You can see we're also kind of holding this cloud, and the cloud's really skinny. So it doesn't act as support or resistance very well until it gets thicker, right? The thicker the cloud is, the better. As it gets skinnier, then it's harder to maintain. Again, the cloud's based off of where your midpoints are over different time frames. The green line is below the blue line. We are trading below the green line as we speak. you'll notice here. And we have what could be classified as a weak bearish trend going on right now. So weak until you break through some significant levels, and then it will take off to the downside, but obviously not bullish at all until you break up, above these levels up to the upside. So back to the market forecast. The near term lines come down. It's not into the lower reversal zone. It's 2 days now below 50. You expect it would bounce. If we're going to bounce off a higher low, near term low here, it should do that in another day or two. So again, with this selling we're seeing in the overnight futures, we'll see if that ends up happening here by the morning, right? That this type of, when you get extreme moves in the overnight and low volume, especially in the Asian markets, they don't tend to last. So we'll see how it lasts and once the market actually opens up tomorrow morning. The momentum line's coming off an extreme low. So we are getting some extremes on the momentum line to the downside, but that's our expectation, right? If we're going to be bullish here, then this near-term bounce, we're going to bounce. And if it doesn't, if the near-term line, if we hold the selling, near-term line gets back in the reversal zone after a relative bearish high point here, after multiple bearish high points, then we're looking at an extended intermediate run where the market sentiment now is poised to drop below. Now it takes a while for the market sentiment to fall, and you can see it's kind of starting to move sideways. But when it gets below 50, that's your market sentiment pullback, which we haven't had on the market for a while now. If you look at the trend over the last 10 days is still pretty high up here at 1.29. In fact, if you were to kind of take a look at this whole area and look over the last 50 days, trying to get as much of this increase in volume on the decliners as possible, you can see the 50-day average now is almost at 1.25. Just for some perspective on how high that is over an extended period of time. So here, let's move this to 1.22. So that's the current where it's at on the 10-day chart. But a little bit more significant timing. You can see where our declining volume is as high over an average basis as it was here when we set this low point and we rallied up. Similar to what we saw here when we had a lot of volatility, all these down, we were moving up in early 2017, but we had a lot of down days here, and that really brought up the volume up to this 1.25 level, and we took off from that point. And of course, your 2015, we set some lows, and of course in 2016, the 50-day average got to these levels, and we took off of those lows. So in the last, however many years is this, 5 years, we've seen the 50-day average get this high. I mean, this is looking like we've had a significant decline. And I mentioned this too, and I'll bring it up here later in the video, that, the markets look like we've been a lot more bearish. And we'll look at that here in just a second. So before we look at some more charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below this video that lets us know, or that will notify you when these videos are posted. Also, hit the thumbs up icon down below the video. That tells us two things. Number one, you like the video today. Number two, you want us to do the video again. So it's our way of getting feedback. If you like us doing these videos, if you want us to do it again day after day, just one click is all we ask to let us know. You can do that right now while you're watching. Also, comment down there. What did you get at? What did you get? Why did you like it? What did you get out of the video today? Let us know at the bottom. Join our website, our website that we have, our investor education website at marketscholars.com. You can do that for free. That will give you access to our Market Outlook forum as well as our market commentary portion of our blog. There's a link right up there in the top right corner of your screen that can subscribe you to that for free. Follow me on Twitter for more content in between these videos from day to day, and join our Facebook group that we've created for the Market Outlook. All right. Also, if you're watching us here on our blog, we do invite you to engage with us on social media. We have the Today's Market Outlook tweet and Facebook post right below the video. If you click on this heart, it opens up a new window. You can click on that like button. Click this image. It takes you to your Facebook account. You can like Today's Market Outlook Facebook post there. Again, the more you engage with us on those platforms, the more they will promote our content to the top of your timeline, so that you're always seeing our stuff even when you're not looking at your timelines all day, every day. All right, but they don't do that unless you engage with us. We try to make it really easy for you here. You can also see some of the classes we have coming up on our. Remember, you get access to these classes with our monthly plus subscription plan. We have a link right above here. That also gets you access to our Market Outlook live trade review videos where I go through these trade ideas all the way to their close. We do that in this video. There's this link. If you click on that, that actually takes you to those videos for those that are subscribers to both our plus and our premium. So more details on those plans here on our pricing page. All right, so back to the charts. Here's our long-term chart, and you can see what this candle looks like. Again, kind of a long lower shadow, but again, we're kind of filling that in here, at least overnight. We'll see how we finish that up. We're still above the 200-day moving average. We're still inside of last week's range. So we're not seeing any significant breakdown here either. We do have falling momentum, but that's typical. One little area of concern is, like, you can see a little bit of a head and shoulders, kind of a triple top where the middle top's a little bit higher. That's a little bit of a concern considering how close they are to each other. Like, that wasn't that long of an intermediate run. This is definitely not that long of an intermediate run. So when you see these shorter intermediate runs, that can start to look like the end of a intermediate rally and more of this pullback, right? We didn't quite get that up here because we pulled down so hard. But that hasn't been the case here. So red flag, right? Nothing to, again, until you break down, there's nothing that's not too significant, but definitely a red flag that would suggest, despite any bullish expectations that I have at least to the end of the year, that they should be tempered, at least right now in my active trading portfolio, with some balance, right, to the bullish and the bearish side of the trade. If you look at the three green arrows, you can see the MACD histogram turned up today. Again, we don't have the green arrow yet. We have the green arrow on the stochastic, similar to the intermediate line turning up. The MACD histogram is turned up. We don't have the green arrow yet, which means the 8-day hasn't crossed back above the 17. In fact, if you look at it on the 2-line version, you can see here that we haven't crossed back above that, and we are below 0. The orange line is below 0 too, and a significant downturn to the downside would change things up, right? If you look at the 1226 version of it, you can see the rally that we had here. In this case, the 12 is below the 26, but they are still both above the 50. These time frames match up better. The 8 and the 17 match up better with the 30, and they are, if I go back to that chart, the 8 and the 17 are below the 30, which typically coincides with the orange line falling, the moving average here falling below the 0 level. So, we're building a base. We haven't broken down. We haven't broken back up yet either. So again, until we do, noise with kind of this bias, kind of long-term bias to the upside. This based on those seasonal factors and other things that we expect into the end of the year. But of course, breaking down, then you'll see that head and shoulders with these slower intermediate runs play themselves out, and whether you can draw a line. I think I have one drawn on another chart, but depending upon how you draw this line here, we'd have to break significantly down below that and hold that, and then you could say, okay, this head and shoulders is going to play out with this big of a move from the top middle high down to the line down in this direction, that type of move. All right, so now let's take a look at the intraday chart, and here's our intraday moves. You can see that late selling we had right before the close. Then obviously we're down. We're actually down to 288 right now in the after hours. Let's see, SPY. Let's pull up SPY. We are at 288. Yeah, we're still floating right there with the 288 level. So we are right at that node, at that volume node in the after hours, the extended hours trading. So again, breaking below that puts 280, because this is where this 288 is where this volume node is. You break below this volume node, and now again, like I said, this gap here, it looks like a gap in volume, but that gap is as big as that volume node is up there, right? And that gap is as big as that volume node is here at 265, so where these lows are. So this is not like your typical gap in volume. There's a lot of volume. That's a big chunk. I mean, the bulk of the point of control is almost at the top of the value area, which means we have a big chunk of volume below us. It makes it more difficult for any big extreme moves like we're falling off a cliff here. So that's what the intraday chart looks like. If you look at the volatility, and this is going to be the interesting thing in the morning, is how much we jump up in the volatility based off of where it feels compared to the back month. You notice we still haven't really surged in volatility to say, okay, we're going to be bearish here for a while, and that surge would be above the 115% level. Anything above 100 or 105, we look at these intermediate low points. In fact, previously the intermediate low points have coincided with moves to the 105% level. We're not even to the 105% level. So depending upon how we open, and also remember too, generally speaking, you get big moves throughout the day to the upside. If we gap up here, that will also more than likely lead to a filled-in candle, which means we close down throughout the day in vol. So that might be a good opportunity to sell some premium when market opens up tomorrow morning, depending upon how it opens up tomorrow morning. All right, so before we break down what's driving this price action, just a review of the technical, our technical analysis summary of the markets, and of course, the expectations are we're still bullish, but we're not breaking out to the upside, we're not breaking down to the downside, even with this overnight move. We're still not breaking below significant support yet either. So, but there is a lot of volatility. There's a lot of volatility, and there's in terms of like the downside volume compared to upside volume. So this type of volatility in the past has led to some pretty decent moves to the upside. This is kind of this level of volatility sets low points, and you can see the VIX. The VIX isn't jiving with that trend, with the level of declining volumes that we're getting in relation to advancing volumes. So in today's move might be kind of the blow-off extended market move where we get that long lower shadow, which is bullish, and we rally back to the upside. So we'll see. We'll see how tomorrow opens up. But that's kind of the expectations going into. Regardless, it's a volatile, noisy time. So it's good to have some balance, as I've mentioned over and over again. And for those that are in our classes, you've seen an example of that in our class portfolios of trades that we've been managing and entering and managing, that we have a pretty decent, in fact, I think our delta is actually pretty, it might be skewed a little to the upside, but it's pretty darn neutral considering, and we've been able to, you've seen how it's performed in this type of market, this type of noisy market that's not going anywhere. So what do you think? Do you agree with that technical assessment? Do you disagree? I want to see your vote. Click on that link popping up top right corner of your screen. Hit the poll, link to the poll. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below on what you're seeing, whether it's a technical indicator or an economic indicator, whatever. What are you seeing that would give you a different outlook than what we just came up with our daily routine here? All right, so I wanted to take a look at a few charts here and have you take a look. This is since January the 26th of 2018. That's when the market peaked in early 2018. This is the second peak the market had here in early October. From that period, you can see this is Treasury yields and crude oil. That's when inflation expectations peaked, and we still had an interest rate hike here. But the dollar has been bullish. Look how bullish the dollar's been since January the 26th. Look how bullish treasuries have been. Look how bullish gold has been. They're the only asset classes above zero. Foreign bonds as well. All these, you can see emerging markets down 20%, developed markets down 15%, small cap stocks down 8%. You take a look at this next chart. This is foreign markets since that same period. You can see France, Japan and France are here at about 12% declines from that level. Russia and Canada aren't doing so bad. UK, India, China, Italy, Germany, South Korea, all down 20% or more, 20 to 30%. Then you look at the sector rotation from that same time frame, and you have some decent returns in technology really coming off of these lows over here. Remember the other significant, they had a pretty decent rally too up to this point, up to October 3rd low. They were up double digits, and then they fell, and they've really come off these lows pretty well. But you notice utilities and real estate are 20% gains. Staples up too. So you look at all these charts, and you would think, well, the S&P 500 is probably down significantly during that time frame, but it's actually up about 2% during that time, where everything else looks like the market's positioning for this fall off the cliff bear market. So again, when you look at the S&P 500 over here now, kind of this long-term view since that October 20, right, that time frame here, it's from the high point that we had there, that all those the market has pretty much positioned itself for recession, for bear market recession. And we got one to an extent here. I mean, I think by definition we had a 20% decline, but not really a multi-month, multi-month, year-long death cross environment. Hardly the case. More like what we saw over here. And so now it's like, okay, are we going to be bearish from this point going forward, when a lot of the setups here at this point currently show that we probably already should have been bearish, that we, like I said, with that trend indicator, might be actually setting up for risk appetite going forward from here. So like I said, like I've said before, either this is the most anticipated and widely expected recession in history, where traders have positioned themselves very well and probably would be the first time that that's ever happened, or there's going to be a pretty decent jump in risk appetite into the end of the year, beginning of next year, before we start getting some pre-election volatility here in the U.S., at least. From an economic calendar standpoint, we did have JOLTS coming out today, and the FOMC minutes. They really have had very, very little impact. It's all been trade expectations here going forward. That's really what's been driving this market. Here, let me just mute that so we don't hear those notifications. Tomorrow we have CPI. That's going to be a very important number after PPI that we had earlier, and jobless claims. Lots of Fed speak, and of course the import and export prices. From an economic standpoint here, the economic surprise index, we have pulled back, including today. We have pulled back, but we're still positive. We're still more positive than we were at the end of 2018 and for all of 2019. So with that being said, we still have, we're still pretty darn bullish here. And even the G10 is at -6. So that's right where that first notch is. You can't really see it as well. It's right where that little first notch is. That is, we're still well off of the lows. We're not really taking off in the positive territory, but we're not nearly off at the lows yet either from an economic standpoint. Of course, any trade volatility has been met with increased rate cut expectations. And as you can see right now, and this is as of right now, this would be including what we're seeing here with the pullback in the futures. We now have a 93% chance of a cut here in October. If you go out to December and you say, okay, well, what are the odds that we'll get? There's a 97% chance of a cut by December. So most of it's in October. Then you see we have about a 50-50 shot of a second one in December. So even with this move, we're still looking at just one cut. You go out to April of next year and you say, okay, 98% chance of a cut by next April. You have an 80% chance of getting a second cut by next April. So pretty high numbers. Those are up. Those 80% numbers are up from where they were a week ago slightly, and slightly up from where they were a month ago. So they've been, relatively at these levels. You can see the second cut would be the 125, 150 area. So if I look at the historical charts for this, the 125, 150, that second cut, the purple line, you can see it's the highest. And then you have this kind of turquoise line here would be the third cut, to 100, 125. So one cut in October, a second cut, and a third cut by next April. And then this red line would represent the fourth cut. So all of those are higher than no cut at all. No cut at all, which is that orange line. And this line, gray line down here at the very bottom being just one cut by next April. And that's really fallen off the cliff. So we are most likely going to get, at least according to the futures market, we're most likely going to get at least another cut sometime at the beginning of next year. That would be a fourth cut of this cycle. So we'll see, are we going to continue cut, or is it just going to be one and done in October until we see what happens through the end of the year into January and March of next year? You can see that GDP numbers were updated today as well, and they're still pretty flat. So it's right around 2%, fluctuating up and down, a few percentage points down, a percentage point or two up. That's where we're at here on the GDP estimates. So we're not, again, expectations from an economic standpoint are still not necessarily declining sharply. That would suggest, again, that the market is prone to falling off a cliff or any kind of recession. That, as you saw before on the previous charts here, this chart, and this chart would suggest that people are positioning for one. So again, these kind of charts after such a long time frame. Usually, when you see the risk asset classes at the top, that's when you start saying, okay, we're overdone. We'll start looking for the market to take off risk and move into safety. But when they've moved into safety for this long, the question now is how much more can we move into safety, and moving out of safety can be a pretty decent boon for the market, for risk appetite as a whole. All right, if you take a look at the sectors here, and you can see the biggest movers today was technology, materials, financials, so different areas of the market. Energy also doing well. If you take a look at the charts here, you can see materials and energy still are your weakest sectors. That strong dollar is really putting some pressure on those dollar-sensitive areas. Staples, utilities, they're the dark green. Along with technology, the only dark green. In fact, utilities is the only dark green with a green line. These don't have red lines yet. They're all yellow lines except for healthcare, which has a weak bullish posture. In fact, financials, industrials, healthcare, these were the big losers, right? They got the weak trends. You also have weak bullish trends in technology and communication services too. Technology kind of leading that march up here. To the upside in terms of that perspective. So, you look at this as a whole, you can see, the market's trying to get things going. We still have relative strength and safety and relative weakness in the dollar-sensitive areas. And, of course, I don't think that's going to change anytime soon. You can still see, the dollar. And the dollar's been subject to, some some weakness in response to this China trade as well. But you can see it's the light pink shading right now, but it's got a pretty decent bullish trend going here on the daily chart as well as on a longer time frame on the weekly chart as well. All right, so for our trade idea of the day, I wanted to take a look at the seasonality of Costco, actually. Let's take a look at Costco. You can see if I go back the last 20 years and put this as a percentage, you can see Costco has a pretty decent run, pretty much from this level going into the end of the year, usually about 5.5% return, all the way up to about 15.5%. So pretty decent rally during this time of year. You can see it's set up for one this year in particular because it's got a nice, good bullish setup going. You notice on the 1 year chart, you got dark green shading and the green line. Nice little kind of breakout pattern here today above these highs here. Then you look at the 3 green arrow chart for Costco, and you notice you got 3 green arrows and a rising MACD histogram. You look at its long-term chart, and you can see you've got some pretty good bullishness already. So it's not like we want to be too long-term or directionally bullish here. It's already really, really high. If you take a look at and put that number in perspective, because this is a relative number, so it's apples to apples all the way back here. You can see this is pretty high. It looks parabolic. It's obviously on a log scale. It's not the case. But we've just been so bullish for so long that it's hard to look for a good trend trade here. You can see too from a Bollinger Band standpoint, it's nicely above its value area, bouncing back up off of this node, the biggest node it has off the value area. So you got lots of support below us. Good high probability technical setup leads to doing a short put vertical spread, a nice high probability strategy for the setup. So selling the 280, buying the 285, that puts basically here. Let's get back to a regular symbol, and I need to go to Market Outlook. So there's our trade. So again, selling the 290, buying the 285, getting a credit of $420 in this case. Here we go. Put that right. That's no offset. $420 in that case, up a little bit already. Remember, we put this trade on during the Market Outlook live videos. So if you want to, see what the trade idea of the day is before the market closes, make sure you're checking out those videos. And you can see we've got $1,000 risk because earnings is after November expiration, well after. So we don't have to worry about earnings having an impact here. And then, of course, we'll take a $420 loss, which puts us all the way past this point. We got a lot of room to work with on a loss potential, down to 281 as of right now. So essentially, you'd have to break back below that node and this low point for us to really say, okay, this isn't working. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forum at marketscholars.com. Again, that's for our free subscribers, so make sure you subscribe to our site to participate there. Open up any new threads, and let's keep this conversation going. What questions, what comments do you have about today's video? Or do you have any questions or comments about something that wasn't in today's video that you want my take on that obviously pertains to the topic? You can also reply to anybody else's thread. So I want to make sure that this conversation keeps going. As always, thank you very, very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment down below. Follow me on Twitter for more content in between the videos, and join our community at Market Scholars, as well as our Facebook group that we created for the Market Outlook video. Have a great rest of your evening, everybody, and we'll see you all tomorrow.